Hey everyone, Levi here, and in this video, I'm going to go over 6 ways that all of you can reduce your tax bill. So if you've started getting ready to file your taxes and are trying to figure out ways to get that amount down and maybe even get a refund, this will be a really easy to follow video with tips you can implement. Obviously, people can really feel anxious about taxes and feel like they're bad or it's going to be this big problem. But by implementing lots of different strategies, including the really basic ones I'll go over, it's possible to totally legally reduce your tax bill and very likely even receive a refund. So again, this guide's just going to go over 6 really actionable steps you can use to achieve these benefits. So the very first of these is contributing to a RRSP, or Registered Retirement Savings Plan. If you're not too familiar with RSPs and how they work, it's a really straightforward method to decrease your taxable income. And kind of how it works is you get a tax deduction. So contributions to your RSP are tax deductible, meaning they reduce your taxable income for the year. So let's say, for example, your taxable income is $60,000. That's how much you make in your job. And then you can contribute $10,000 to your RSP. Then when you're paying taxes, it shows up and you pay taxes as if your income is only $50,000. So let's say your tax rate was 25%. That would result in a savings of $2,500, and that's how much less taxes you would owe. An important thing to be aware of with RSPs is the contribution deadline. So the impact of your tax bill is just for the current year. So you have to ensure contributions are made by the end of February the following year. So for example, for the 2024 tax year, contributions that to be deducted on that have to be made by end of February, so February 28th, 2025. Contributions made from March onwards apply to the next tax year. So that's definitely something to be aware of. And then also the other thing to really be aware of are contribution limits. So you accrue contribution room, and you need to make sure you're aware of the total limit so that you can put in as much as you want without going over that. Because if you do, then you might get penalized. So definitely make sure you pay attention to your contribution limits. The next tip is utilizing a TFSA, or tax-free savings account. This account is a platform for tax-free investment growth. And basically how this works is investment income earned within that account isn't taxed, allowing your investments to grow without tax implications. This is a little bit different in terms of contribution, where it just increases annually every January 1st. Unused room just carry forwards forever, so starting early can definitely enhance your potential. And then you can also withdraw money from it, which is withdrawn tax-free, unlike your RSP, hence the tax-free savings part. But to restore your contribution room for the following year, you have to withdraw before December 31st. So if you take money out in December, you'll get that contribution room back in January. So you'll definitely want to plan that. So using a TFSA won't really give you a tax refund, but it can help save you a capital gains tax. That's a big thing to be aware of while you're investing. The next tip is engaging in tax loss harvesting. This is applicable to those people who have non-registered investment accounts. This doesn't apply to, say, your RSP, but if you are investing in non-registered accounts and have been for a while and have some gains, then tax loss harvesting can help offset those gains. And sort of the way this works, for those of you who might not know, is you sell underperforming stocks at a loss, so stocks that have gone down since you bought them, to offset gains from other investments that have gone up, which reduces your taxable capital gains and in turn the amount you would have to pay in capital gains tax. So say, for example, you have a stock that you made $5,000, so you have a $5,000 gain, but you have another stock that is a $5,000 loss. If you sell both, they'll offset each other, resulting in no taxable gain and in turn, no taxes owing. Now, the one kind of rule with that is to utilize the loss for tax purposes and saving. You have to avoid repurchasing the same or identical stock within 30 days before or after. So say you have a stock that's down, you can't just sell it, claim the tax loss deduction, and then immediately buy back 5 seconds later. You do have to wait 30 days. So you do have to be aware of that, but despite that, it can still be a very useful tool for people in a situation, in certain situations. The next of the tips is opening an FHSA or first home savings account. This account combines the benefits of both your RSP and your TFSAs, specifically for prospective first-time homebuyers. So the contributions are tax deductible, similar to your RSP. You put money in, and then it reduces your taxable income, and in turn will most likely save you money on your taxes owing for the year. And then your withdrawals are tax-free. So withdrawals for purchasing a first home are tax-free, similar to a TFSA. So it kind of combines the best of both. And it's a great way to reduce your current tax bill and then also invest and grow tax-free. Limits with this one, if you're not aware, lifetime contribution limit is $40,000 with an annual limit of $8,000. So you get $8,000 a year every year up to $40,000 limit. If you haven't already, you definitely want to open one because the contribution room only starts accumulating once you've made it. So opening it early allows your contribution room to accumulate. Another tax tip is to contribute to an RESP, Registered Education Savings Plan. This is a little bit more of a niche thing as it specifically supports savings for a child's post-secondary education. So that's the only kind of benefit of it. So obviously there's only certain people who'd be in a situation that they can benefit from it, but the growth is tax-free. So investments within that RESP grow tax-free until the withdrawal. There is also a government grant feature, and in this, the government matches 20% of the first $2,500 contributed annually up to a lifetime maximum of $7,200 through the CESG, Canada Education Savings Grant. So by putting $2,500 in, the government will match, and then eventually you'll actually get $7,200 in free money from the government. So it's definitely something you want to maximize and contribute that $2,500 each year so you can secure that full benefit over time. The very last one, which I'm sure most people know about, but this is another really common way people lower their taxes owing, is making charitable contributions. Donating to registered charities not only supports causes that you care about, but it does provide a tax benefit. Specifically, they provide tax credits, so donations provided they're registered charity, can yield federal and provincial tax credits, which reduce your overall tax liability and tax owing. So math on this will vary a little bit depending on provinces and stuff, but at a federal level, a $1,000 donation would result in a federal tax credit of around $260. And then you'd get provincial credits as well, but again, that varies by region. So you get a significant amount of that gift back. But with this, again, you should be really careful. Ensure you donate to one registered charities and obtain official tax receipts so you can claim these credits. Anyways, that's the video, just 6 super quick tips that really anyone can implement. These might all be applicable to you, or maybe just some of them are, but hopefully you're able to use these either this year in 2025 or in the future as you file your taxes and hopefully get the total amount you owe down and maybe even get a refund. If you have any questions, leave them down below and me or other people in the comments can get back to you.